Welcome back, everybody, to Cash Flow Podcast. I'm one of your hosts, Amit Dogan, and I'm here with
Caesar Dogan.
the big guy.
The big guy. We're not doing the big guy anymore. But we are talking about something big.
Yes.
Now, mortgages. Okay, everybody's saying we talk mortgages all the time. Let's shed a little insight. Caesar, we were talking about it off camera. What were you saying about the mortgages now?
What was I saying about mortgages?
We were talking about how the government is allowing the consumers to use a 30-year amortization on insured mortgages. However, it's only for pre-construction properties.
Yes. So it has to be new build. You're a first-time home buyer, and you have less than 20%. So they are allowing you to do a 30-year amortization, which they did not allow. So it gives you greater flexibility in terms of how much income you need to qualify for it. So 25 years versus 30 years, let's say, hypothetically speaking, in one, you would need 100,000 because it's all contingent on how much mortgage you're pulling. But with 30 years, you only need, let's say, 80. So realistically, more people can qualify, which will most likely, depending on what's happening, properties under $1 million, it may you'll see more properties between, let's say, 800 to $1 million more so.
Really?
Well, they're going to be put.
This is amazing.
To get into the technicality of things, when it's a 30-year amortization as opposed to a 25-year, the total debt service ratios are more lenient, or you have more room to qualify for the mortgage.
So why would they do this though? Like, let's
would they do that?
Devil's advocate.
Well,
Sure.
they
Why?
see that right
So let's
now.
ask you, what's going on? You tell us.
First and foremost, I think we should explain what an insured mortgage is rather than an uninsured.
So very, very quick. Insured typically means anything less than 20%, even though more than 20 can be insured as well. But generally speaking, anything less than 20% is called a high ratio deal. So which means that it has to be insured. So whether it's CMHC or Sagen or Canada Guarantee, they have to insure it for the bank to consider a mortgage.
Yeah.
Anything that's uninsured,
default insurance, mortgage
yes,
default insurance.
that's what it is. Yes. And anything over you putting 20%, it could be uninsured. So it's a conventional mortgage. That's what they call it.
When did this actually happen? Is this something that's always been in place?
Yes.
It's always been in place.
Yeah, pretty much.
How come they don't talk about that? Like I'm listening to Caesar and I'm like, wow. How come this isn't more publicized?
Well, it is very publicized.
It is.
Yeah, especially for the past, you can say since 2017, it's very, very publicized. But before that, like when, let's say my father first bought his house in early 2000s or in the 1990s, this wasn't an issue because we didn't have any of these qualifying procedures that we have now. Because after 2008, a lot has changed as well. Don't
forget.
Since
the economic collapse.
Well, in the U.S. especially, right? So people that shouldn't be buying properties were buying properties. They were making impulsive or emotional decisions or undertaking financial obligations that they could not maintain.
But now, who do you guys blame in that? Do you blame the mortgage brokers and the realtors or the consumers?
If you want to blame anything, you blame it on everybody. But at the end of the day, you're the consumer. You need to do your thinking.
But
so you need to educate
mortgage
yourself.
brokers would say, yeah, you can do it. Just like in The Wolf of Wall Street. Or not The Wolf of Wall Street, The Big Short. They're like, yeah, you can do it. Of course you can do it. I'm like,
yeah, but the bank is accepting it and the people are okay with it. So if I tell you, let's say you hear this more and more often. I don't know. I think it was a CBC documentary. Or they asked me to come here and they asked for this payment or that. You already know what's going on. Like you can't be ignorant. You can't be completely oblivious to it. People are completely aware of what's going on. They just choose to stay silent or because the desire to buy a house is so pressing that they are okay with bending and twisting things.
Who is?
The consumer.
Yeah.
The consumer technically doesn't have the power to do that, though.
Well, typically speaking, yes, they don't do it, but they're completely okay with it.
Isn't it the banks that are manipulating things? Because they're the ones who are they're like the conductors. And we're all singing, but they're the ones who change the tone of the whole industry. Because they're the ones who say, okay, 30 years. Now all of a sudden, maybe I can buy.
Okay, so it's not the bank that's making this decision if that's what you're asking. So from 25 to 30, it's a provincial government. So OFC is the regulatory body that sees this. And if it's not for the Canadian government and the provincial government, because it's regulated, they can say you can do this and you cannot do this. So if you look at, so these banks that we're talking about, they're A-side material. So B, for instance, they can stretch it to 35 years. At one point, it was 40 years. But it's the government that's saying, yes, go ahead and do this. My undertake of it is they're allowing 30-year amortization on pre-construction only. So which means you can go with 10% down, assuming that you can qualify, 10% down and go and buy a property for $900,000 and make it 30-year amortization, which was only 25 up until now.
Yeah.
So, but by doing that, why only pre-construction? Why not resale?
Why is that?
So my take on it is they want to stimulate the big boys that are building properties. They're not interested in stimulating the local economies, so to say. Mm-hmm. They're more interested about protecting, let's say, Mattamy Homes. They know where, because they need to make sure that the construction industry is well stimulated, because it's the backbone of our economy.
Especially with the influx of, immigration and people that are migrating to Canada.
We're not building new homes. Yeah. I don't know if you know that, Steph. We're not building new homes. Everything is sort of in a stalemate position.
And so I deal with a lot of builders, and a lot of them have told me the same thing. Obviously, everybody has their own story. It's because the borrowing costs are really, really high. Yeah. They're waiting until the interest goes down a bit. And since it hasn't gone down, they're not putting shovels in the ground.
So here, you need to look at which builders you're referring to. Because based on what you're telling me, it's new builds. No, new builds. The guy's building one custom house. Those are not the people I'm referring to.
No. This guy builds condominiums.
Okay,
condo complexes.
Okay, so, well, that makes sense. So the borrowing is high.
Super high.
That obviously impacts everything, top to bottom. But at the same time, prices have come down. So if you have a property, think about it this way. So it depends on which industry we're talking about, because they're having different challenges. So for you to just smear them with the same paint color, it's a wrong approach. So assume that it's a subdivision property. You're going to be building 200, 300 properties.
Okay.
So let's say it's in Bradford. There's many lots that are still available. The builder is only building if they sell.
The builder is only building if they sell.
Yeah, they won't open up phase 2, for example.
Really?
Yeah, they won't. But here's the catch, though. So we had a client that bought a property in Bradford for $1.4 million. The bank came in, the bank sending their own appraisal. They came in and they said to my client, they said, look, this property is only 1.36. So there's a 40,000 shortfall. And then my client said, that's impossible, because the builder's right now selling my own property or similar property for 1.6. So the builder hasn't reduced their price. They said, you know what? We don't care. We don't give a shit. We want 1.6 million. Whether the market for it is 1.6 or the market value is 136, they don't care. If you want to buy it at 1.6, we'll build it. Otherwise, you know what? We already have this lot. We'll just wait until it sells.
But that's the problem. Now they got to pay property tax on it. They have to pay property tax on the lot.
But don't forget, though, that's minimal, though. It's vacant. It's considered a vacant lot.
Let me ask you something before we get on to the lower interest rates, okay? When it comes to new builds, they're not going to budge on the prices. But here's what's happening. Resale is starting to drop. So now the question is, why is anyone going to buy new build if resale is coming down?
So people tend to prefer new build because it gives them flexibility and timing. So the new build
to pay, you mean?
Yeah. No, well, timing to pay, it's an installments. So it's the deposit. There's a deposit structure, and let's say a year and a half later, you're gonna take possession of the property. So it gives people that flexibility so that they can prepare accordingly. And everybody, I don't know if this is a thing they want. There is this emotional, impulsive decision to say, you know what, I opened the door.
Like I'm the only owner.
I'm the first owner.
So if there's any issues,
the property's
it's mine.
Brand new.
So now, and I personally have transitioned out of that. I prefer a resale.
Me too.
Something that's already been established. All the footing is there. The house has stopped moving, and it's been weathered in. A new build, you don't know what's going to happen. Now, how do you feel about that?
Honestly, I am indifferent. It really doesn't matter. As long as I own a piece of real estate, that's fine with me.
Really?
Yeah.
How do you feel about the lower interest rates?
The lower interest rates is something that I'm very much looking forward to because one, it opens up more business in all aspects of life, construction, real estate, and just typical day-to-day living. Because I feel like the interest rates are a big component of the cost of living as well.
Here's the problem. I'm going to ask you guys a question. With these interest rates potentially going lower, what about a variable mortgage? What do you guys feel about? How do you guys feel about variable mortgages?
We've had many clients choose a variable, and we don't think that it's a bad shout, mainly because of the recent discussions with the economists and how they forecast a 1/4 point decrease in June and in the upcoming months as well.
If it's a personal decision, if I had a property right now and I need to close on it, I would most likely do a 2 or 3 year, depending on what it is. I think that's probably the best, because a year
it's a much
into
higher
it,
rate though, right?
So I'll give you an example. Like, these are like give or take rough numbers. So a variable, let's say you open up any bank, give or take, you're paying about 7%. That's the variable.
7.
Yeah,
7%.
like 6.95.
Yeah,
That's
let's say
scary amount.
7%.
Prime minus 0.5. But
It's
that's
not prime
only
minus 0.5. Who's doing prime?
0.25. My apologies. But these are for conventional mortgages. So this means that this property cannot be insured. So it's when the property values are over $1 million and you're looking to obtain.
Yeah, so maybe that's a good point to make, because
Exactly.
these are not insured.
Tell me.
When it's insured, the banks feel a lot more comfortable lending. So provided that there's any issues, the insurer comes in and vouches for the client and pays for any sort of costs that are owed. So that helps. A variable is 7%, give or take. A 3 year is about 5.7,
Okay.
give or take.
How much is 1 year?
7.2.
Oh.
Yeah, yeah.
It's like 7%.
So you might as well be on a variable at that point.
Well,
Yeah.
see, that's the thing, though.
But
it
then
depends
again,
on what you want to do.
Exactly, Steph. Because there's people that want to, for example, there's a client that has a pre-construction coming up. They are going to close on the property. They only want to keep the property for about a year, and they would just want to sell it. So rather than taking a 3-year term, which is a lower interest rate, if you sell before the 3 years is up, then you're going to pay mortgage penalty. Whereas
what's the penalty? Is it
It's
10%?
So it's usually 3 months interest or IRD, whichever is higher.
What's IRD?
IRD is interest rate differential. So at the time that you're looking to close off that mortgage, whatever the interest rate is, in comparison to what you have right now, the differential is
Based
what
on
you're
3
paying.
months.
Exactly.
It's actually a lot
so
more
it's not that bad.
sophisticated. Give or take, it boils down
very
to
hard to
3
calculate.
months.
So you're looking at
So give or take, I'll tell you,
depends.
if you're buying a property, let's say your mortgage is about, let's say, 700,000. You do a 2 year versus a 3 year, and if you were to sell it 16 months in, the mortgage penalty between the 2 and the 3 years should be about the same.
Yeah.
really.
Yeah, it shouldn't, because it's going to be, when you do the differential, usually the 3 months interest is slightly higher, so it won't make any difference. And typically also, you can renew 6 months prior to your actual maturity without any
Really?
penalty. So you can do an early renewal if you wanted to. So if you're in, let's say you're locked in, hypothetically speaking, at 6%, 2.5 years has gone by, it's a 3 year. As soon as it hits 2.5 years, you can say, look, I want to renew. So hypothetically speaking, let's say it's at 4%, they'll still allow you to do it without any penalty.
And there's also other, like, for example, the big banks like Scotiabank, for example, if you have a 5-year fixed term, let's just say, you say that the interest rates are decreasing, you can request a lower interest rate for that
But
year,
you're
for
locked
example.
in, though.
You're locked in, but the bank, they still value their customers and they still cut them some slack and reduce their interest rate.
No, but how long into the term do you have to be in order for them to
So
consider
if you
it?
have a 5-year fixed term,
Okay.
hypothetically,
Okay.
with Scotiabank, every single year, let's just say the first year, Bank of Canada dropped their rates by 1/4%.
Right.
You can request a lower interest rate for that year as well, and you can do that every single year
You're
for the
kidding.
5 years. Yes, and I recently
for
found
sure?
that out as well.
Did you hear about this, Caesar?
They
That's
do it, but
crazy.
it's all
It's all
'cause
case by case.
No,
and
I have different mortgage agents say this, and the bank guys, they say it too. it all depends on the bank, and it all depends if it makes sense to the bank or not. So let's say you're in a 5-year and you're in year 2. They do their math. They're not dumb.
Exactly.
Right? The remaining 3 years, let's say you pay a penalty for 25 years. They go, look, 25,000, or this guy leaves us and we're going to be out. If it doesn't make sense for the bank, they'll reduce it. You can speak to them and they can do an exception or call their higher ups and they'll make it
just
work.
Tell you straight up, no, we're not
If that mortgage, if it's like a mobile mortgage specialist, something like that, that probably means they just don't want to deal with you.
Okay.
Typically, if they raise the issue, so to say, you escalate it. Oh, we don't want to lose a client, and if the numbers make sense, they will, because you can leave.
Interesting.
And you can add that, let's say, penalty to somewhere else. And in fact, you see this more and more. A bank says, look, you switch your mortgage, we'll give you $3,000. We'll pay your penalty. We'll pay the fine.
Just to get the business.
Well, yeah, because think about it. How long are you, how many times have you changed your mortgage once you go in?
Yeah,
you lock yourself in at, let's say, RBC or one of these major banks, or depending, First National, whatever it may be, and you're there for life. So realistically, why would you change?
You wouldn't.
You wouldn't. So the banks wants to give you that reason not to change.
It's kind of like when you get a cell phone. If you're unhappy with how Rogers is, and you ask them, nowadays they're gonna help you. They're gonna reduce it so they can keep you. Now, this is obviously a different situation. Okay, boys. Last question for this episode, and this is all tied into this. I'm gonna use me as an example. Would you tell me sell it and buy at the rate that's gonna be current in November? Or do you want me to renew for a year and see how the interest rates drop next year and then sell? What would you recommend I do?
Option 2.
Selling your property.
Yeah.
This is why would you want to sell your property?
Well, in my circumstance, because I have my mortgage coming up and I don't want to stay in the area.
Okay.
But should I renew for one more year because the interest rates are hopefully going to go down next year, or should I just sell it at the current rate?
So if you sell your property right now, you're going to be using that money to buy a new property? Is this what you're saying?
Maybe.
Okay, so if you're not intending on buying, don't sell now. Okay, that's one. So selling is not a good option. Right now, it's not a good idea to sell.
Okay.
And if you're going to be renewing your mortgage, don't renew it right now. Wait until September, October.
Yeah.
Literally 3 weeks before, and and then say, look, based on what it is. And at the same time, even if you sign, you can go back to the bank and say, look, I did this, but you guys reduced the interest rates. So I want the new interest rates. So you got to cry.
Tell me something. If we had to get more information, where could they find you?
You guys can find me at Mortgages by Amit on Instagram, website mortgagesbyamit.ca, and
me, Instagram, Caesar Homes Canada or CaesarHomes.com.
And we will.
Oh, it's .ca. Yeah, see, I'm losing it.
Spotify, YouTube, all that good stuff.
Yeah, all that good stuff. Yeah, look at this guy in the background, just posing for me and saying, you screwed up.
And we'll see them next time.
peace out.